everyone. Just a quick sound check. Can get started. All right, audio seems to be going through okay on my side. Welcome back to another webinar session. Today it's Friday, so it is going to be an educational session. Correct me if I'm wrong, is this week 5 or week 6? I think it is week 5, right? No, is it week 6? Anyway, tonight we are going to talk about alternative Japanese charting techniques. Normally I do this towards the end of the the series, but I think I'm going to swap this out a little bit. I think all of us kind of need another viewpoint of the market with how intense the market has been the past 2 months. Okay, so welcome back everyone. My name is Vito and Henjoto. We can get this started. Any questions that you have, do type it in, but tonight it's going to be more of a hybrid session, so we are going to go through the slides. There's not a lot of stuff to go through the slides, just a few basic understandings, and then we are going to take a look at some of the live market examples. So yeah. We'll see if we have time to look at the market, but if we do have time to look at the market, and we can talk about what's going on in the market this week. But I hope most of you got the hints on Wednesday's session. Okay, so let's kick it off. Just to begin with, just a quick general advice and risk warning disclaimer. Note that any advice given is deemed to be of general nature, as the information or advice given does not take into account your particular objectives, financial situations, or needs. Therefore, at all times, you should consider the appropriateness of the advice before you act further. We do not offer signal service, manage funds, or other personalized advisory services. Please be aware of scams that promise guaranteed returns or managed accounts. Safeties and Forex are leveraged products that carry a high level of risk and are not suitable for everyone. You can lose more than your initial deposit, so you should ensure CFD and Forex trading meets your investment objectives. Strategies and charts used in this presentation are for example only. You are reminded that past performance is not indicative of future performance. Alright guys, this is going to be an English session, so do type in your questions in English. If you want to spam in this session, maybe do it somewhere else so everyone else can focus. Okay. Alright, so tonight we are going to talk very quickly on the purpose of alternative Japanese charting, why people use it. Touch briefly on the Heikin-Ashi. I think a lot of you are going to be very familiar with the Heikin-Ashi. This is probably the most relatable Japanese charting techniques that you can use, because most of you, we did talk about candlesticks last week, right? So this is going to be very similar to that. And then we are going to talk about Renko and Kagi. These two are actually a little bit advanced, but I'm going to break it down as simple as I can. And then I'll go through why I say it's time independent, because it works differently than traditional charting techniques. Okay, so the purpose of alternative charting techniques is, number one, to filter out market noise. So if you don't know the underlying direction, if it confuses you, switching to an alternative charting techniques typically clears out a lot of the market noise. So because it clears out a lot of the market noise, you can kind of use it on the small time frame if you want to. In fact, Renko and Kagi, it's ideal if you actually have access to tick charts and then use Renko and Kagi on tick. You'll get a much faster confirmation than using it on, let's say, on 15-minute time frame, the hourly time frame, or the daily time frame. It is going to give you a different outlook on the market. Again, it will clear out a lot of the market noise. And with the exception of the Heikin-Ashi, Renko and Kagi are actually price-based, and it doesn't really chime well in terms of the time axis there that we normally use is going to be really unique. Okay, so time axis will be different from traditional chartings like candlesticks, line, and bar chart. Typically we have traditional time axis working like if you're looking at the hourly chart, every hour is going to be a new period. The Renko and Kagi doesn't work that way. They work differently and they don't really care about the period of a certain hour or a 15-minute time frame or a day even. Okay, because they filter out all of these noises, it's actually easier to establish key support and resistance in the market. You will actually be shocked in terms of what kind of key support and resistance is actually being outlaid by this charting techniques. Okay. I saw a message here on the learn Forex trading. You are in one step in the right direction here. We are learning right now. Okay, I'm educating. You guys are learning, obviously. Okay, so let's go on. So Heikin-Ashi. You guys are going to be familiar with this. You might have actually come across Heikin-Ashi before. Heikin-Ashi in Japanese means average. So as the name implies, Heikin has a different calculation from ordinary candlesticks. It's just not looking at the OLHC standard, but it also uses the following formula. So it'll actually average the close. It will average the open. Okay, so it'll actually add the previous bar open and then the close of the previous bar divided by 2. Then that will give you the new open for the Heikin-Ashi. And then you've got the high, which is the maximum of the high, open, and close, and then the low, which is the minimum of the low, open, and close. So it'll actually work differently, and it'll actually show you different stuff on the chart. All right, so this calculation makes Heikin-Ashi as a noise filter. It will remove extremely weak candles at times of high volatility, or actually fill in gaps that occur in the market. So filling the gaps, it's probably something new to a lot of you guys that probably just started out in currencies. When we talk about gaps, I'll show you an example later on the Apple stocks. In the equity market, you actually see a lot of gaps, and this is where if you come across an instrument that has a lot of gaps, it will be useful in using this Japanese charting techniques. Okay. So Heikin-Ashi, again, it's also used to monitor the underlying trend. So we are going back to week 3 here, talking about trends. Because to me, if you don't get the whole trends, then you're not really trading at your full potential here. If you don't really understand how a trend works and how do you actually look at the trends. Okay. So with Heikin-Ashi, simple candlestick patterns such as hammer, engulfing, piercing, morning, and evening star, this can also be applied to Heikin-Ashi charts. So whatever you learned last week during the candlestick sessions, you can actually apply it to Heikin-Ashi. Price patterns like chart breakouts, the flags, pennants, triangles that we talk about also, that's also going to apply and going to be treated the same as in candlesticks. Okay. Right, so this is a comparison of the Heikin-Ashi on a pound USD on a 15-minute time frame. You can basically look at how noisy it is, the one on the left here. We basically have a gap pretty much at the beginning of the run to the upside. If you take a look at the Heikin-Ashi here, take a look at the size of the wicks and the gaps. Because it's an average, it will actually fill in those gaps. So yeah, it kind of just identify a much clearer outlook compared to a normal candlestick patterns where we actually have a bearish candle, bullish candle. In the Heikin-Ashi, once it's average, even if the market goes up a little bit, if the trend is still to the downside, or if the trend is still strong enough to the downside, it will identify you with a bearish candle. So it could be useful in terms of filtering out some of the market noises here. So that's Heikin-Ashi. Let me just give you a quick look at the Heikin-Ashi here. So we have the pound USD. This is on the candlesticks, right? Looks pretty okay. We know this has been trending and whatever. But if we switch into the Heikin-Ashi, by the way, Heikin-Ashi, it's if you're using MT4, it's probably going to be, you know, behind a custom indicator, and there are a lot of variations to custom indicators using Heikin-Ashi. So if you want a shortcut, you can try out TradingView and then use the Heikin-Ashi that's already built in there. You know, just as an alternative charting to your traditional MT4. So you guys can try it out. But anyway, with the Heikin-Ashi, it's actually going to filter it out. So you'll know when the trend is actually strong to the downside. It will still identify that trend. It's going to be a different one to candlesticks. So I'm going to switch back to candlesticks. See if you guys can pick it up. All right, so this is candlesticks. You'll see you know, a mix of bearish candle in between the bullish candle, for example, over here. So let's focus on this side. All right, let's take a look at this one here, and then I'll switch to Heikin-Ashi. You'll notice if the run up to the upside it's not done yet, it doesn't actually switch to a bearish candle. So that's one way to look at things if you want to filter out some of the market noises. This is on the hourly time frame. I can go onto a small time frame, let's say on the 5-minute time frame. You know, and by looking at the Heikin-Ashi, it's still going to be okay. But if I switch to the candlesticks, it is going to be a little bit more choppy. It is a little bit more confusing. It's harder to actually pick out what is actually really going on in the market. Okay, so let me switch back again to Heikin-Ashi so you guys can have a clear look at it, right? It shifts things up a little bit. It is a lot smoother. You can actually pick up and identify the underlying trend really, really quickly because you don't actually have a lot of noise in the market. So I would say if you're confused about the market, give Heikin-Ashi a go. It could actually filter out a lot of the noise there. It actually, you know, if you're trading on a small time frame where there's a lot more market noise, this becomes really useful. But again, if you want to use it on the daily, no biggie. You can use it on the daily. It just works about the same on the daily. Okay, so let's switch into the candlesticks. See if you guys can pick out the difference between the daily Heikin-Ashi and the hourly. Sorry, the normal candlesticks. You'll see that this is a little bit more chaotic, right? It's not organized. You know the direction is going somewhere, but it's not really neatly organized for you. Heikin-Ashi does that for you by averaging price. So yeah, in terms of breakout levels and whatever, if you take a look at how I highlight all the swing high and the swing lows here, the breakout levels are pretty much identical, right? So you're not, even though it's an average of price, it doesn't really kind of switch out or part ways differently from a normal candlesticks that you typically use. So, you know, typical support and resistance, breakouts, that's still going to apply. Chart patterns going to apply, triangles are still going to apply, flags are still going to be useful, right? But the point with Heikin-Ashi is really just so that you can actually quickly look at the market without a lot of the noise. It's just more of an organized candlesticks, right? So let me switch back to the traditional candlestick again so you can actually take a look at it. It does look a little bit more messy, right? Looks like market is, you know, choppy. There's a little bit of a correction. There's a little bit of a retracement going on there that, you know, could confuse a lot of traders out there, especially in the past few months here. But if you go with the Heikin-Ashi, smooths it out, not a big problem at all. Okay. Last week or previous chart can view again. I'm not sure what you mean by that. Yeah, Heikin-Ashi is a very nice candle to filter out noise, but sometimes it gets a little bit confusing. It gets a little bit confusing in the sense that you don't have the same high, open, low, and close to a certain degree. Most of the time, you're going to get it. In terms of confusing, that really depends. But I mean, if you take a look at Heikin-Ashi and just consider that as more of a organized candlesticks. I think that's the way you look at Heikin-Ashi. Because to me, as a charting technique, it doesn't really serve other purpose than really filtering out the market noise. That's from my experience. So if you're okay with candlesticks and you can identify the underlying trend, you don't really have a hard time with it, and you're more familiar with candlesticks as its core, then by all means stick with candlesticks. Heikin-Ashi could be useful to people that are probably new to the market. They don't know, although they don't have the tools to filter out the market noises. Like I could use Ichimoku, I could use stochastics, right? But not a lot of people get that they're not there in terms of consistency yet, and they're not there yet in terms of experience in using all those other tools, or they might be using other tools to look at the market, right? So if you're confused, if you're new, give Heikin-Ashi a try. It might help you out. But to me, Heikin-Ashi, there are other options like the Renko and Kagi, which is a little bit more advanced, a little bit more unique in terms of how to use them. But for price traders, they are a little bit more useful. Heikin-Ashi is pretty much just an organized candlesticks. It will help you. If you use it and compare it, you'll kind of pick it up. It's really hard to explain the difference between Heikin-Ashi and candlesticks until you actually experience it. It basically just filters out a lot of the market noise in there. Yep, line chart, most definitely. If you are familiar with line charts, you can keep using line charts to look at the underlying trend. We did talk about this in week 3 as well. So this is an option. You can use line charts if you want to. You can use histograms if you're more familiar. If you feel like looking at line chart is a little bit too lonely. By the way, if you are new here and if you want to know what a line chart is, it's basically just one simple moving average. So it is an average of price. Again, the purpose is going to be the same. It's just going to show you the underlying trend. That's pretty much it. Okay, so that's Heikin-Ashi. Nothing too hard, nothing too fancy. It is more of an organized candlesticks, to say the least. Okay, all right, let's go get your notes out and dive into Renko. Okay, so Renko, it's derived from Renga, which means brick in Japanese. Renko is unique in that it is purely price driven. Okay, it will ignore instrument time. It will ignore the volumes. If you're trading equities, right, it will actually ignore all of them. This is actually really useful to filter out volatility in the market. Okay, you'll see why in a minute here. So it will print out one brick after a set amount of change has occurred in the market, and we'll talk about this later on. But it will provide you with a really black and white market perspective. There's no spikes, there's no long wicks with candlesticks. I know the newer version of Renko, some people use wicks with it, but I would say stick to the traditional basis where the wicks are actually gone. You don't have spikes, you don't have long wicks in the candlesticks, you don't have any bearish pattern, whatever pattern. It's really simple. It's really black or white. It's either the market is in a bullish market condition or is it in a bearish market condition. To me, it's more like an on and off switch. That's pretty much it. So Renko it's really crazy useful if you are familiar with it. If you get more familiar with Renko, you start using Renko, it will actually click with you. It's going to be very, very useful as a noise filter and determining the direction of the underlying trend, more so than Heikin-Ashi, because Heikin-Ashi still have that time axis attached to it. Renko doesn't have that. Renko is purely based on price changes. So not only is it useful for identifying trends, it's super useful in determining support and resistance levels for one reason, because it doesn't change until a certain price changes happen in the market. That way, you know, if you take a look at the chart later on and you see, you know, a certain particular price level, you know, if you look at candlesticks, it attempted to break it. With Renko, it'll just stay flat. Simple as that. So it's really like an on and off switch, to put it simply. Okay, very useful in determining support and resistance level. Usually used with traditional chart patterns. You can actually use trend lines with this. You can actually identify a breakout with previous key levels in the market with Renko. So, you know, some chart patterns do apply. Divergences no longer apply to Renko. I don't think it works in that sense where it'll actually tell you the, you know, price is creating a new high. Sometimes it doesn't pick it up because it moves in blocks, right? So when we talk about the blocks or the bricks here, you can actually set a range to it. So you can actually change the Renko settings so that every 10 pips, every 10 pips that changes in the market, it will actually print out a new brick. You can tweak with that, but I wouldn't recommend you tweaking with that as a beginner, because it really, you need to tailor it very specifically to a certain instrument. So for example, the dollar yen doesn't work with a 10 pip range block. It doesn't work that way. It typically works better around these, you know, 80 pips or 100 pips block. So every 1 yen kind of thing. So again, you might want to play around with it, but you know, as a beginner, I probably wouldn't recommend you tweaking that brick settings. But you know, how we look at that, you know, we are looking for 3 consecutive changes in a certain direction. If we set it up to a 10 to 20 pips brick, it will actually indicate the short-term trend or the intraday trend. If you have a range of 30 to 50 pips, it will actually start identifying with the medium-term trend. Okay, so again, this is going to be tough because, you know, I like to call it intraday trend, but remember, we're not working with a proper time axis here when we take a look at Renko. Okay. So this changes in brick is actually calculated based on the close. As such, if you use Renko for 50 minutes, it will require a close of the 50 minutes before the changes happen. So as I said, if you have access to tick prices, this would be the fastest changes to the market. It will be based on tick close. If you don't have access to tick, you can use the 1 minute time frame, the 5 minute time frame. Traditional equity traders typically look at 10 minutes time frame as a minimum. Personally, I'll look at the 10 minutes time frame, and that's the reason why I actually trade with the 10 minutes time frame if I'm trading intraday. Some of you guys probably know about this, which is really strange to a lot of you guys. Because the 10 minutes time frame, it's not really exposed to a lot of currency traders. Intraday equity traders use 10 minutes time frame. Okay, so the reason why I say don't tweak it around, because those are actually based on the traditional method. Nowadays, Renko is actually using the ATR forwarding calculation. So it really makes Renko and Kagi easier to apply to various instruments. And I can show you later, if I tweak it with the traditional settings, it could break the Renko charting. So again, you need to tailor suit it to a very specific instrument in terms of whether or not you want to use Renko if you want to set a specific break. Okay, so this is what Renko looks like. Again, as I said, this is really black and white view of the market. You can change it to black and white if you want to, but I use green and red. It's really that, nothing much to do with it. Now if you take a look at, you know, the prices here might be a little bit unique here. This was taken obviously a long time ago. If you take a look at where the euro yen is, it's still at around 122, 121. Anyway, this is Renko based on a 10 pip breakout, 10 pips range. So every block that you see here is actually about 10 pips. All right. If the market doesn't change by a minimum of 10 pips, it won't actually print out a brick. So let's say if it's at 121, it will need to post a price. It will need to close above 121.10 to actually print out one bullish brick. to say. Okay, it will need to break below. It will actually, price needs to close below 121.90 to actually print out one break below if you set it to 10 pips. The smaller the range of the bricks that you set, you are going to get a lot more data in there. But if you start using a much bigger block like 30 pips and stuff like that, it will show you a different thing. Okay, so you can play around with it, but I would really, life is already hard enough as it is. Why make it harder? A lot of people actually use the ATR 40, and to me it works enough. It works good enough. The way I look at it, because it's based on the average true range, so it kind of gives you a really good range for the market that the Renko could be based on. Might not be accurate to a T, but it is dynamic because the ATR 14 will change around, and the calculation is actually going to be based on the ATR 14. To me, it's a little bit more dynamic. So if we have a market that's really volatile, the ATR 14 range will go up, and then the new blocks will get printed out according to that new volatility. So one day it could be every 50 pips, like the CPI numbers came out, and all of a sudden it starts adjusting to 100 pips because the range all of a sudden just got bigger. To avoid being noisy, it adjusted, and then the next break that's going to get posted, instead of being 50 pips block, it could be 75 pips block, and so forth. So to me, it is super useful. If you take a look at the time axis here, you'll start noticing it is a little bit weird, because if you take a look at, you don't have a lot of information on this chart here, but all of a sudden you can actually look at, 5 years worth of information just on the daily chart. You take a look at the time axis, it starts in around 2015 and all the way to 2020. So yeah, it is unique in a sense that it doesn't really care about the time at the bottom there. Time still works. I mean, time still flows. It just doesn't flow in the same context as a normal charting techniques, right? All right. How do I know when my market is going down? Easy, Nelson. Go back to the webinar 3 weeks ago. I think we cleared that out in terms of understanding the direction of the trends. Okay. So ready? So this is the same British pound example that we have, and then I'm going to switch to Renko. All of a sudden it's different. Take a look at the highlighted regions that I have here. Take a look at it and focus on it carefully, because I'm going to create a much bigger box so we can actually look at the same thing. All right. So I'm just going to highlight blue. Now I'm going to switch to Renko, ATR 14 dynamic. You start noticing what happens there, the range that we have the whole chart with. All of a sudden it's just compressed to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 bricks, right? Let me switch back again. Basically the information from May to September, it's going to get compressed into an 11 blocks of Renko. And the dates goes all the way back to 2017. Okay, so this is where it becomes unique, right? So I can go into the hourly time frame. You'll start noticing the daily, whatever is on the daily, all of a sudden works the same as if it's on the hourly, right? The same block that we have on the daily just now on candlesticks now matches the Renko on the hourly time frame. Doesn't make sense, right? It really doesn't make sense in that context. How could you have a daily chart matching exactly the same as the hourly chart just by swapping, the type of charts you look at? But let me go back again. So I'll go to daily. I'll switch back to candlesticks. This is data from the month of May to September. If I go to Renko and I go to the hourly time frame, That same information is now reflected on the hourly on the Renko, right? So this is definitely going to give you a new perspective of the market. This is going to give you a completely different look of the market. So hopefully this could be useful in the sense that if you take a look at what's going on here, you know that CPI information, you know, we have a huge drop, right, on the normal candlesticks. Stuff like movement today, for example. How's that? The movement today, it's really volatile. The movement yesterday, we had a little bit of a spike because the Bank of Japan intervenes, right? So, you know, all those are gonna get filtered out. If I go into the Renko on the daily, it doesn't even tell you anything. In fact, the last information that it printed out was basically on the 20th of September. So that's that. If I go into the hourly time frame, all those whipsaws, remember we're looking at 3 consecutive changes. So like this one here, I can zoom in a little bit. Right, so this one, for example, for the market to actually reverse to the upside, it will actually need to create 3 green blocks. It doesn't create that. Even with all that volatility, it doesn't create that. So there you go. It filters out a lot of the spikes in market or whatever, and all of a sudden you start thinking, oh yeah, you know, pound USD is going to recover. You know, I kept going on steady. I gave out a little bit of a warning before the FOMC happens. I kind of gave you clues on the direction of the market, what to expect and what not on the Wednesday session. So if you guys didn't watch it, maybe pick it up. It's something to learn again as well if you want to know more about the interest rate decisions, how they come to it, and stuff like that. Anyway, so the overall trend doesn't change. The Renko doesn't really change. It doesn't give you that new information where there is a reversal in the market. It just doesn't show you that. It really prints out the block as they see it fit. It's basically just per price movement. Now, because I set it to ATR 14 dynamic, take a look at the first block, second block is around 45 pips, right? So it's consistent at 45 pips at this point in time. But that's not going to be necessarily the case all the time. If I switch this to the daily time frame, it's going to give you a different block as well. Okay, so what works on the hourly time frame is basically a 45 pips block. If you're not okay, you know, trading 45 pip block, then maybe Renko is not for you. But I mean, if you're really confused in terms of the general direction of the market, switch to Renko. It will give you a clear understanding of the market there. Now, if I go into the daily, if you take a look at the range here on the daily per brick, it's 150 pips. All right, so it's huge, right? That's the thing with the time frame in Renko. If you switch to a small time frame, it will give you a smaller brick size, and that's pretty much it. So if I go into the 15-minute time frame, this is going to give you about 30 pips in terms of range. Okay, so I can go smaller, right? This is on the 5 minutes, and per brick is going to be 20 bricks. So the shortcut here, if you want to tweak and experiment with the brick size, I would say switch to the time frames, because now the time frames doesn't really relate to price. It really is more in terms of how big you want per block to be, right? How big of a change you want to see in the market. Then you switch to the small time frame if you want it to be a little bit more quicker. I'm happy with the hourly time frame on the Renko because it represents the daily movement if I use traditional charting methods. So I think it is a good substitute. That's why I look at daily and I look at the hourly time frame. These are the only 2 time frames that I'll look into if I'm trading. 4-hourly time frame, 15-minute time frame, that's probably another good combination. But if you look at the daily time frame, the 5-minute time frame, obviously it's not going to work for you. It just doesn't work that way. We will talk about multiple time frames in terms of how we use it, but I'll leave that a little bit more later once you understand the basics a little bit more. Okay, so Renko, Nothing really surprising in terms of how you use Renko. All these support and resistance that I have highlighted here at 1.12, sorry, 1.2, 1.2250. You know how it was high there. You know, see how market doesn't change up there. It doesn't actually break above it. That's the kind of thing with Renko. Even if it slip up to the downside, you know, it will stay there for a bit. We can take a look at this one here in terms of the movement in the month of July for 2 weeks. The Renko, you know, kind of whipsaws a little bit there, but it still comes back. It doesn't immediately just run off a certain support and resistance. If the support and resistance is strong, it's key support and resistance, obviously price changes are still going to matter. So if you're confused with all this, let me just pick one. I've actually never applied Renko to gold, but hey, why not? Let's apply it to gold, right? See how we look at gold here right now in terms of resistance. We have around 1680, which is we can wrap it up to about 16. Let's just have it at 1680. How's that? Because we take a look at, you know, how Renko is rejected there. It failed. It created 2 bricks. It doesn't create the 3rd bricks, and then it fell back down. So it doesn't actually change the trend yet. So the overall trend for gold basically is still to the downside ever since, you know, the drop below 1700. All right, let me switch into the candlestick. Let me get rid of some of the stuff here. I'll still keep 1795 because I like 1795 there. 1775 would probably leave it as well, just in case we need it in the future. Anyway, so I'm going to switch back to candlesticks. See, that 3 or 4 or 5 Renko, it constitutes a sideways market on the early time frame that is what? 120 bars, 120 hours, right? It just get compressed into 6 Renkos. So yeah, those sideways market condition that you saw on the other time frame, see how noisy it is. It gets a little bit confusing. You buy in and then you get out. Or what happened here? I don't know what's going on with the market and stuff like that. But you switch to Renko, it's so clear. It's clear as day that, you know, price is unable to break above 1680. It never printed out the 3rd break. Therefore, the downtrend that was started here remains to the downside. We consider that as a retracement and so forth, right? Simple. All right. I'll go through the chat, but if you have any questions regarding Renko, ask now, because we're moving on to Kagi, which could get a little bit more complex. I like Kagi a lot more than Renko, but when I first started out in terms of using Japanese charting methods, I used Renko. Okay, I'm gonna go through the chat here. If you have any questions regarding Renko, do type it in. I'm gonna go through the chat here before we run off to Kagi, which is the last one that we are gonna talk about today. I close my eyes, I've opened my eyes, and pound pairs falling to the ground. We can. That's the thing. I really want to talk about it because we have that PMI numbers right today. We also have comments from Bank of England as well. So again, we have 13 central banks. A lot of them are in Asia that actually hikes up interest rate as well. I'm just trying to get through the chats here. See if there's anything else. And if we have time, we'll talk about the PMI numbers as well. Hi. Chat from okay. Someone spamming. Yep. Do you use order block trading? If possible, please make a video on order block. It's actually a really sensitive issue to actually talk about order blocks here. But in terms of order blocks, you can actually use them, but I don't. For one reason, the only time I actually used that was actually when the Euro USD hits parity with the US dollar. Other than that, I don't actually use that because it's more of a contrarian trading if you use order blocks. And then the information in terms of the order blocks that you get, how accurate are they, right? Because every broker, they are gonna have a different order blocks. In terms of how do you compile most of them, you can only make a rough estimate, and I don't like it because it's really more for contrarian trading. There, you kind of expect the market to get rejected or bounce off a certain level, so be mindful of that. Renko has shadows. Yeah. So there's this option here. If you leave the wick on, it will have wicks. So I don't use that. I don't even know why that feature was actually in there. But yeah, I don't use that. So yeah, you can turn it off if you want to. I'll say turn it off. You don't actually really need it. Renko will be available in a custom indicator, and I'll be honest with you in terms of Renko and drawing Renko. Custom indicators, in terms of doing Renko, it's a little bit more complex. You get the coding wrong, it'll just show you a different number, but it will fall under a custom indicator, so you actually need to look at it on the source library, the MetaTrader source library. So have a look at that. Is that MQL4 files and stuff like that. But if you want a shortcut, I'm not sure if Renko or Kagi is actually available for free on TradingView. I think it might be locked to a certain time frame, and I don't think it actually opens up for the hourly time frame on Renko and Kagi. I'm not sure what it is right now, but I think that was the case for free accounts, I believe. Okay, we good? No questions on Renko? Alright, let's get you more confused right now. We will talk about Kagi. Kagi in Japanese means key, so I'm really liking it because you call a chart a key. First used in 1870, also become one of the charting methods used by W.D. Gann, which is probably something you didn't know, that he actually uses Kagi to trade. Kagi, like the trading methods that originated in Japan, typical like the Renko, is more directed towards average and reducing market noise, right? Like Renko, Kagi is not related to time but change or percentage reversal that occurs in price. Again, this is going to be based in price. So I would say Renko and Kagi probably falls into the same category, but they have a different way of looking at a potential reversal. I like Kagi a lot more because it clicks in a sense that it's more the same as how in the Western world we look at a trend, right? We look at a higher high, lower low to identify trends. That's basically what Kagi does. It basically detects those higher highs if there's a break above the higher high or whatever. So we'll go on to the chart later on, but if you want to screenshot this and then come back to it later on, I would highly recommend it. So the green, or it could be colored, it could not be colored. It's typically colored and could be bold at the same time. Any bullish candle or bold candles or a thick candle, it's called the yang line, right? The red or thin line is called the yin. So it's yin yang, right? You guys probably heard of yin yang, which is, you guys probably thought, yeah, it's Chinese and stuff like that. Hey, it also applies in Japanese as well. Okay, the flat line above, it's actually called the shoulder. So any flat line that shows up after a green bold line, we call that a shoulder. Any flat line below, or any flat line following a red thin line, or any flat line following the yin line, we call it a waist, right? Basically, if you see shoulders and waist That's your support and resistance that's being formed in the market. Okay, so if you saw a change from yin or yang, that's going to yin to yang, that's going to be a buy signal. A change from yang to yin, or blue, obviously green to red, that's going to be a sell signal. It's going to be a lot more clear once I open up the chart next. Okay, let me remind you, when you use Renko and Kagi, because of its nature that it only moves when there are significant changes in the market, the oscillator or indicators such as Ichimoku will change according to the period of that it happens. So it will actually look different. There's a little bit of a typo here, but in essence, if you look at traditional oscillators and Ichimoku Kinko Hyo, when you apply it to the Kagi chart and the Renko chart, they are going to be different from what is shown on the chart that uses candlestick because of that time axis, especially with Ichimoku, because it detects the change in periods. Momentum also detect changes in periods. In terms of Renko and Kagi, you don't get that change in periods through time, but through price. Okay, so this is what it looks like. You know, it might look a little bit more confusing, but once you get the idea, once you click on the idea, I'll explain it later on. It's actually super simple, right? So let's take a look at the yin line. Notice the changes there. It's a green line that goes down, and it only becomes red once it actually breaks a waistline. So any changes that goes past shoulder or waist, it will form the change in the color there, right? It will transform from yin to yang. Therefore, the logic is this: if there's an uptrend, all right, it's going to be green. It won't turn red until it actually breaks the swing low. That's the logic behind it. So if it breaks the swing low, it will turn red. It will be an indication that the market has started to fail because it broke below a swing low. And that breaking below the swing low is actually the first sign of a potential change in a trend. It's not a confirmation, but it is the first sign of a potential trend change. All right. Okay. So if price move below a set reversal level, for vertical lines to be drawn, it actually has to break through a few sets, like shoulders as well. It will actually form the shoulders, after a certain period of time. But the breakouts that we have, the changes that we have, that's because it broke through a swing low, right? It will become green if it broke through a swing high. Okay, so it is actually super, super useful. During a period where there's a lot of market noise, it will zigzag a little bit, but in terms of range, you can actually kind of limit the risk there by identifying the support and resistance. So again, you can take a screenshot of this one if you want to, but we are going to go through the practical side anyway, so I can show you straight away what's going on there. Okay, so this is an application with Ichimoku Cloud if you want to. Kagi works fine with Ichimoku Cloud, same rule as Ichimoku Cloud, but if you take a look at the stochastics there, it'll start to get really, really jaggy because it just doesn't work that way. Okay, Kagi still works okay with Ichimoku. Same rule applies in terms of changes in trend. You get double confirmation with Ichimoku. Okay, so the same chart here, the same application on the Ichimoku and oscillator. This is on a traditional candlestick. This is what happens if you switch to a Kagi. Take a look at where the Ichimoku Cloud is. This one is actually within the Ichimoku Cloud in terms of candlesticks. Kagi is still all the way up there. Okay, so this is a lot noisier, but this is just an example that you can actually use Kagi with Ichimoku. That's completely fine. Okay, all right, let's go on to our GBP/USD example because we already have that established. Yeah, so let me go back to a candlestick first on the daily, just to give you an indication of what we're looking at. Okay, pretty simple. This is candlesticks. Now I'm going to switch to Kagi. Okay, that's it. All of a sudden, the formation that we have again gets compressed because it doesn't change until a certain swing high or swing low is broken. then it will shift. That's as simple as that. Okay, now if you take a look at what I mean by a broken, or the changes in the trend line, sorry, in the changes in yin to yang or yang to yin, it's this, because price broke through that the waistline. As simple as that. So if I were to highlight what that waistline is, it will be at 1.23379. A break in that will change the color of the chart. It will bring it into more of a bearish formation. Now, if I were to switch onto the hourly time frame, sorry, onto a candlestick, right? That level was actually a break below this line as an average. Now, if you take a look at where the resistance is, that's where the market actually come back to test it and fail and initiate more of a downtrend. Okay, so you can actually use this to find key support and resistance. Every time you see a waistline, every time you see a shoulder line, you can draw a horizontal line just to kind of cap it. So if you're looking for the immediate resistance for pound USD right now, where is it going to be? Simple. All you need to do is look for the waistline. Draw it. That's it. Okay. Resistance above that, we already have that drawn. It's actually at 1.2250. So we can switch back to a normal candlestick if you want to. It will identify a new resistance. That's basically close to a swing high in the move to the downside, which is, on a traditional sense, you don't actually consider that a swing high, right? You won't actually pick that up as a swing high, because a lot of traders are going to pick that up as this. Get what I mean? So it will pick up subtle changes in price. Again, it is based on price. It is based on ADR 14. It is dynamic. It will change accordingly. But it will pick up some resistances or support that's not actually detectable on a traditional candlesticks, for example. Okay. Renko. Sorry. Does Renko shadows? No. Account block? I don't know. If I'm going to use Renko, which time frame I would usually use it? I would use it on the hourly time frame, because it will give me an average of about 40 to 50 pips per block. That suits me okay. Daily is going to give you maybe 100 or 150 depending on the currencies. It will be different to every currency. For example, with let's go back to the Renko for a limit. All right. So the daily range on Renko for pound USD is at 150 pips per block, right? If I were to go onto the dollar yen, it will be different. It should be different. No, it's not. Okay. Normally it is different depending on the currencies. You might not get the same measurement to every currencies in terms of Renko. Okay. So let's get back to Kagi. If I were to highlight whatever we noticed on the normal candlesticks, nothing. It's not going to pick up anything. In fact, it's still red. It has been red. In the initial run to the downside is actually basically on the breakout there. So if you saw the Renko and you want to use it as a trading strategy, you can actually do that when it starts to switch into the yin line. All right. So green to red. You can have your stop loss maybe a little bit higher than whatever that high is going to be. Let me turn off my magnet for a little bit. You can actually adjust your stop loss a little bit higher. And then obviously, because this is more of a trending strategy, you are still going to hold this position up until now. And that's a lot. If you take a look at this, if you trade purely on just using Kagi. And this is why a lot of swing traders, a lot of the more professional traders, they use Kagi, because it's going to give you a huge potential in the market that you're not missing out on the trend. It doesn't really exit a certain trend until it's really huge in terms of direction. So I mean, in terms of stop loss, your initial stop loss could be at 400 pips to 500 pips. But hey, what are you looking at? You're looking at a potential of 1,000 pips. As you guys are not wrong in listening to that. That's 1,000 pips. That's basically a drop from 1.2250 all the way down to 1.1. So it is huge. And right now, you're likely going to be in the trend because you still have the projections to the downside on this one here. No changes. We don't have any yang line being formed. Until that yang line happens, then you're actually still going to stay in that trade. So, you know, by the time it breaks down the second waistline, you could have your stop loss at break even pretty much. So yeah, yin yang, it gets confusing, but in terms of how you use it, super simple, super easy. Very similar to Renko. It really gives you a black and white view of the market. This one here, we don't even need to use chart patterns on Kagi. That's why I like Kagi a lot more than Renko. Renko, we still need to look at a potential breakout. We need to identify that breakouts. Kagi does all that for you. So I like Kagi a lot more in that context. I used to hate Kagi because when I learned Kagi, I can never get the concept. I can never get the understanding of a Kagi because it looks like a worm scribbling around. You know, you guys old enough to have a Nokia phone, it looks like that snake game, right? The old snake game you used to play on your keypads. Or maybe I'm just old, I don't know, right? It literally looks like a snake game. And it's confusing. You know, I put it aside. When I used to work in Japan, the traders over there teach me how to use this and stuff like that. This is the one thing I don't want to pick it up, and to me, I think that was the biggest mistake that I've ever done in my trading career, because I picked it up a little bit later. It clicked with me a little bit later, but the concept is simple, and I'm going to share it with you right now. It's the changes in color is basically the same as breaking a swing high or swing low that will change a trend. It's as simple as that. Once you get the idea, once it clicks, then you'll actually start using this a lot more. Okay? So, this is Kagi on the daily. Okay, you can have Kagi on the hourly time frame. It's going to be different as well because it's going to have a different set of range because the ATR 14 is dynamic. Okay, if you go onto the 15-minute time frame and you want to trade a shorter term, you want to trade something small with a smaller stop loss, yeah, that's completely okay. You can have that short position there. You can have your stop loss here. Trading on a 15-minute time frame, you're still looking at a stop loss of around 80 pips. Potential target of around 150 pips, or maybe even more right now if you're still in that trade, right? So time-wise, if you're typically trading on the hourly time frame, you want to use Kagi on a 10-minute time frame or the 15-minute time frame for intraday trading. That's completely okay. If you want to use Kagi on the hourly time frame to start swing trading, that's completely okay. Daily, if you use Kagi on the daily, it's going to be huge because you're catching the kind of the longer term trend. Okay, but that's simple as that. You want to use it on a small time frame, it will just bring the scale down a little bit. So adjust it accordingly to something that you're actually more familiar with. But just let me warn you, the smaller the time frame goes, there's a lot more noise in the market. You'll start noticing a yin and yang line that starts scribbling around like that. So this is a 5-minute time frame. And this is the 10-minute time frame. This is the 15-minute time frame. You start going to the hourly, you'll start noticing that there's actually a lot less noise in the market. Okay, so use it however you want, but the same rule applies. The smaller time frame is, you're still gonna get noises in the market. Okay, in terms of resistances, in terms of correction level, can we actually measure this with Fib? Yes, surprisingly. Because Fib is based on price changes as well, right? So you can actually use this with a Fib. So for example, you saw these changes here between this and that. You can actually filter it out where the rejection, the pullback, the correction, that's actually still going to be at 61.8%. So yeah, you can actually measure correction levels with Fibs if you want to, by using Kagi. So this is a lot more flexible to me than Renko. I don't like Renko in a sense that it locks you into a certain range and you actually won't print out changes until it breaks outside of that range. To me, I find that a little bit lacking. That's pretty much it. Kagi, same concept. It's basically me not having to worry about looking at candlestick. That's a lot messier. So if I were to switch on the candlesticks, with this one trade here, right? Simple, right? You can take a look at that. It's super simple. If I were to switch this to a candlestick, it's not as simple, because it'll show you a market where it's actually flat for a long period of time. This is a period where you start biting your nails. You might actually get off that position and say, hey, it won't come down anymore. Why? Because it's actually not breaking support over here. See that? You actually will stay in that trade. In fact, if you go by traditional charting methods, you take a look at that level 1.12. That was the level we were actually really worried about this week, that the pound USD could actually bounce off that 1.12. We were limiting ourselves, if we use traditional methodology, by just limiting a target to 1.12. Okay, but with Kagi, you're not limited to that. You don't actually have a lot of that period. That's concern here. It's huge. I mean, if you take a look at this one here in terms of range, it is 25 bars. It's a period of 1 day. Okay, you get that from one movement on the Kagi. So I like this because it's super simple to use. Renko is only available on lower time frame on Pro Plus and Premium. Okay, but at least you get to see it on daily, so you can kind of get the general direction there. Okay. All right. Simple and on time. How's that? Okay. I'm not gonna talk about what's going on in the market right now, but if you're curious what's going on with pound. Bank of England actually say the UK could actually already be in recession. There was comments from members from the Bank of England that actually says Bank of England doesn't actually really care what the pound sterling does in terms of the currency movement. And the exact word that they used was currency goes up, currency goes down, so it doesn't really matter. But in terms of the economic condition in the UK, if Bank of England admitted or recognized that the economy could actually already be in a recession, I think that's a strong word to send out to the market that, hey, UK economy is not doing well. And then the PMI numbers comes out. Okay, it wasn't great either. Manufacturing PMI was 48.5. It remains below 40. It remains below 50, slightly higher than the previous one, but the services PMI, it dropped from 50.9 to 49.2. So it takes services and manufacturing down below 50, and that is a first sign of economic contraction. So in a sense, whatever Bank of England said yesterday, and that was basically confirmed with the PMI numbers that was out today. So simple as that. Really more one-to-one kind of scenario what's going on there. In terms of the FOMC, hopefully you guys get the hint that I sent out on Wednesday. So you missed out and you want to know what's really going on, go watch the Wednesday session. It's not really I think I spent about half an hour talking about the potential for that FOMC. It's already done, it's already dusted, but again, it wasn't the interest rate that triggered the movement in the market, it was something else. You guys really curious about that something else, go watch the Wednesday's live trading session. I explained that in details over there. Okay. All right, so no questions? I'm gonna hang around for a while here, but if there's no questions, we can wrap it up for tonight. No? Okay. So hopefully this has been useful to you, and I normally do this on more of an advanced level, but I kind of want to do this on a beginner level just to give you all the tools that you can get in terms of understanding the trend, because I think moving forward, I think we can start leaving behind trend, or maybe it will change your perspective in terms of whether you should be a contrarian trader or whether you should be a trend following trader, I would say you want consistency, be a trend following trader. That's just my experience to that. Where can I find a Kagi chart? You can actually look for Kagi and Renko. If you're using MT4, you can go into the library, the custom indicator library, and look for the Renko and Kagi. But if you guys want a shortcut, just open up TradingView. Even on the free account, you can get Kagi and Renko. I think it's on the daily chart, if I believe someone just confirmed that. How do you get a link to Wednesday live trading sessions? If you're on YouTube right now, you click on the OctaFX Forex broker link. Go to the list of videos. You're gonna see my face there. It's a Wednesday session, which is dated 21st of September. So if you can watch that. So yeah, then the link is actually on the OctaFX YouTube channel. Yeah, I think I like Kagi, so much simpler. Yes, I like Kagi a lot more too. Super simple. So yeah, I mean, if you guys want to learn more about fundamentals, I would highly recommend watching the live trading session on the 21st of September 2022. Yeah, I spend a little bit of a time to talk about what really matters with the FOMC. It's not really just the interest rate. There was a 100 pip drop at 7:10 p.m. on new dollar yen, 143, 142. Was that inflammation play or some fat finger mistake? That was a surprise intervention, right? That caught a lot of us by surprise. I was actually seriously in shock. I was actually away from my desk, finished my meeting, and then look at the chart and was like, well, what's going on? So Bank of Japan and the Japanese government actually intervene in the FX market because they're afraid that the dollar yen could actually break above 145 on the back of the FOMC's comment. So they were just, and I talked about this before, and the reason why I don't really care so much about that intervention, because we all know this intervention is actually going to be short-lived, right? I posted this out on Telegram as well yesterday. I was like, hey, how long is this going to be, right? And how effective is it going to be? For now, yeah, it kept the market by at 145. But if you take a look at the market reaction, it drops to about 140 on the dollar yen. In one day, it picked itself back up, to 143, 142. So how effective is it going to be in terms of controlling the dollar yen from exceeding 145? I thought they were actually going to intervene at 150, but obviously 145, that's definitely kind of the we know right now in terms of 145 they might intervene again once price gets to 145. So in that sense, it is a very similar situation to the Euro Swiss in 2016, where the Swiss National Bank was intervening all the time. I believe it was 1.2. When Euro Swiss drops down below 1.2, they intervene. Just so that they keep the Swiss franc a little bit weaker. That intervention eventually runs out, right? Because every time it was a limit. So basically SMB created a floor, an artificial floor. And basically every time Euro Swiss touches that floor, they need to buy Euro and sell Swiss. So Bank of Japan might be scaring the market right now, and they say like, my cap is at 145. If market goes back to 145, I might intervene again. That's something that you need to consider. We need to see if Bank of Japan is actually going to intervene again once it reaches 145. Right now, the market is actually attempting for that pull back up to 145 right now. If we take a look at the whole market reaction on the dollar yen, so I know this is rambling on a little bit, but if we take a look at the whole progress on the dollar yen here, market is actually attempting that pullback right now. Okay, take a look at the Ichimoku cloud. It's actually super thin. This is actually very easy to transition. Price could actually go back up to 145 again. So we'll see what happens here. But if there's no intervention at 145, then traders will know Bank of Japan is not really serious in terms of intervening there, and they could actually break 145. Right now, there's actually going to be a lot of orders, stop orders being lined up at 145. So once it touches 145, 145, 25, it will actually trigger around 246. But we'll see what happens here. I'm staying away until I get more confirmation in terms of how Bank of Japan is behaving right now. If they don't intervene at 145, then I feel safe. But if they keep intervening at 145, then we need to change up our strategy to actually trade range bound if you're trading the dollar yen. This doesn't apply just to the dollar yen. This will actually apply to the euro yen, the sterling yen as well, because that intervention strengthens yen against the general basket of currencies. So it doesn't. It's not just isolated to dollar yen. So if you're trading euro yen, sterling yen, you're looking at pretty much the same scenario. Dollar is just a lot more stronger right now. The dollar yen is picking up a lot more. But if you take a look at the euro yen and sterling yen, they're not really able to fight back that intervention. In fact, sterling was pretty much a goner, right? So dollar yen is unique in that context where we're actually looking at a strong US dollar. If you take a look at the dollar index, the sell-off yesterday, back down to 110.50, bounces off that 110.50. So really, the Bank of Japan intervention doesn't really do much to combat the dollar strength, right? This is my first time of hearing this and I'm a little bit confused. Don't worry about it. First time you learn about Kagi, Renko and stuff like that, you are going to get confused. But the key here is just get the key changes that I outlined just now. Once you get it, you click, that's good. Can we use moving average with Kagi? I guess so. I never tried it, but I guess you can use it. Should work. Okay. Sounds good. Okay, everyone have a great weekend. Monday we'll have our outlook on Monday. Telegram channel will have their session on Monday, and then live trading session on Wednesday, and then we'll have another educational session on Friday. Next week it's going to be Fibonacci. So we are moving up to a higher grade right now. We will talk about Fibonacci next week. So I guess I'll see you around. Good luck with your trades and have a great, fantastic weekend. Stay safe.